like the brilliant yet diabolical Amy Dunn, debt has some very redeeming qualities when executed correctly. Like you can get richer and wealthier using debt than you can if you don't. But isn't that risky? No, debt isn't risky, but the people using it can be. Because if you mess it up, you'll struggle to get wealthy while you're still young enough to enjoy it. I mean, sure, you can always use the whole compound interest thing to work its miracle, but 75% of your life will be behind you by the time that magic trick pays off. But when you use debt the right way, you can compound assets. And that traditional 40-year plan your parents and grandparents followed can be collapsed into 4 or 5 years. No fooling. I see financial freedom created here all the time at Epic. There's Parker and Corey and Ryan and Mackenzie and Josh and Brad and Tony, Cindy, and Enrique, to name just a few. And they all use debt to make it happen. And I'm going to show you how you can do it too. So here's the deal. When you leverage debt, you get to take a small portion of your own resources to acquire a large portion of someone else's. It's not just about multiplying returns, of which it does, but the purpose and benefits go much deeper. Here, watch this. The use of debt empowers the borrower to gain full control of an asset, of which gives the borrower the full benefits of the asset without fully owning it. And those benefits, they can be the revenue, the appreciation, depreciation, and use of the assets. As well, long-term debt positions you on the right side of the economy with regard to transferring ownership from the lender to the borrower through amortization. And when done right, it's the asset itself that does the work to pay down the debt for you, the borrower. And then there's this. The 40-year high inflation that we're experiencing is paying down the debt for you too. You see, the increased revenues, salaries, commissions, and bonuses that you receive in the future due to inflation is going to make the debt you take on today easier and easier to manage. You see, your income's going to grow, but your debt payments will not. Governments around the world, they understand this. And then there's Apple and Microsoft. As of the recording of this, 490 of the Fortune 500 companies are leveraging debt to grow their fortunes because they understand this. Rich people understand this. And if you want to be rich, you deserve to understand it too. Watch this. Our currency, because of inflation, is a depreciating asset. So the rich borrow this depreciating asset to purchase appreciating assets, specifically assets that they can control. And here are 3 controllable assets to consider using debt for first. Number 1, invest in yourself, like through self-education, training, mentors, and/or associations, in the interest of becoming competent in the acquisition, management, and disposition of which asset class you plan to use the debt for. Make yourself better. Make your network better. You can control you. Number 2, invest in your business. With regard to anything that will improve directly or indirectly the revenue and value of your business, and most specifically the profit of your business. You can control your business far more easily than someone else's. And then number 3, invest in real estate. It's the final frontier where the average person has a legitimate shot at creating epic wealth. And that's mostly because of the average person's ability to leverage debt in real estate in a way that they can't in other mainstream investment options. And now I'm going to show you how this works. And I'm going to use real estate as the model. But these principles can be applied to other assets as well. So I'm going to use some simple numbers to keep the math easy, and do your best to not get bogged down into the numbers, but place your focus more on the concept of how the leveraging of debt builds wealth and builds it much faster than you could without it. As long as you understand the concept, you can then later plug in your own numbers to correlate with your own resources, your own asset class, your own market, and your own financial goals. So here, we have a house valued at $100,000. And you were able to find a motivated seller and acquire the property for $80,000. That's what we show people how to do here at Epic, by the way. And it's not terribly important right now, but if you feel that this is impossible or really difficult to do to buy at a discount like this one, it's not. There are a few different links in the description below to some free Epic trainings that'll show you exactly how to do it. Alrighty, so we're purchasing this $100,000 property for $80,000. We're going to place 20% down, $16,000, and leverage the rest from a bank, $64,000. Let's say 5% for a traditional 30-year loan, giving us a monthly payment of $344. We now control this property without fully owning it. But the control gives us the right to any revenue the property can produce, the right to any appreciation the property experiences, the right to all of the tax advantages through depreciation, the interest and business deductions, the benefit of the amortization, that's the paying down of the debt, as well as the preservation of our money's value through real estate's hedge against inflation. We get all of that. We leverage debt here to take a small portion of our own resources to acquire a large portion of someone else's. Then next, we go find a tenant that will pay us, say, $1,200 per month to live in the property, and each month we'll collect that rent payment to make our mortgage payment of $344, paying down the debt. That's the amortization at work. So to this point, we have used debt to create income, we use that income to pay off the debt, and we also get to use the tax advantages of real estate to further offset those debt payments. I mean, those tax advantages include the deductions of the cost of borrowing the money, the management costs, the depreciation, and other allowable business costs. I mean, those tax advantages, they add up pretty darn quickly, often to the point where you can show to the government a loss on paper, yet a profit in the bank. And Uncle Sam's gonna give you a big thumbs up for that too. So now, we'll sit on this property for, say, 3 years. Here's what happens after those 3 years. The national average housing appreciation since 1968 per the National Association of Realtors is 5.4%. Now, I know we experienced much greater appreciation these last couple of years, but I'm gonna keep it really conservative just to show you that the appreciation isn't what real estate is all about. Therefore, timing the market isn't as important as most people think. So let's cut the appreciation down to just 3%, of which would cause the property's value to jump $110,000 after 3 years. And when we add in the 3 years of debt paydown, that gives us a principal paydown of $3,000. And when you factor the original equity with the appreciation and with the principal paydown, all together, that gives us a new equity position of $49,000. Through leveraging debt, we have turned $16,000 into $49,000, a 300% return in 3 years. That's sick, right? You can now leverage that $49,000 of equity into new debt to acquire 3 more of these properties and repeat the process. And in 3 years, do it again into 9 more properties, which would give you 13 total properties in less than 10 years. So keeping the math simple, you've turned $16,000 into a small $1 million real estate empire with somewhere in the ballpark of $500,000 of equity. The type of returns that would give your financial planner an inferiority complex. And I didn't even factor in the positive cash flow from the rent yet. Now, you're probably thinking, great, Matt, I get it. I need to use debt like the rich do. I'll just go to my bank tomorrow and get started. But here's what's about to shock you. The game just changed. The very system that you're counting on to help you borrow like the rich is about to lock you out completely. And when you understand what's really happening behind the scenes with banks right now, you'll realize why the wealthy moved their money years ago and why you need to consider doing the same thing.
You are going to see a crack in the bond market.
Think the 2008 crash was bad? This bond market bomb is 10 times bigger, and it's set to hit investors and business owners first.
It is going to happen.
And it won't be a crash. It'll be a lockout.
We borrowed and spent $10 trillion from 2020 to today. We also bought $4 trillion of your securities. Those numbers are true globally. The QE of us was $8 trillion. The QE of the rest of the world is another $8 trillion, something like that. You're talking about huge sums of money.
Jamie Dimon just told you why, but nobody's listening. Let's fix that in the next 8 minutes, because here's what's happening now and why it matters for your next deal.
I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine.
Jamie Dimon isn't some YouTube doomer. He's the king of Wall Street. But his warning, it's not new. In 1994, Citigroup's John Reed warned of irrational complacency weeks before $1.5 trillion vanished overnight. Here's why that matters to you. When Wall Street's biggest players start warning, it means the money you need for deals is about to get a lot harder to find. History doesn't repeat, but it rhymes loud. And here's what that means. I always thought that was funny, but here's what it means. The U.S. national debt, $37 trillion. That's $107,000 for every American, including your kids.
You know, these are very large numbers.
So translation, the government is broke. And when governments go broke, they make it harder for everyone else to borrow money.
You're talking about huge sums of money. I don't really know the full effect of that.
For years, the Fed flooded banks with cheap money. That's why loans were easy to get. But since 2022, they've pulled $2.1 trillion back out of the system. Less money in the system means less money for your deals. But here's the gut punch. The warning light that's predicted every recession since 1970, flashing red for 2 years straight, a record. And Diamond isn't guessing. The last bond market collapse erased $1.5 trillion. But today, the market's 24 times bigger, $37 trillion debt bomb versus $4.8 trillion in 94. So if you do the math, a $4.8 trillion problem caused chaos in 1994. What happens when a $37 trillion problem explodes? Your funding doesn't just get expensive, it disappears. The government's response? But hidden fact, net interest will hit 13.55% of federal spending in 2025. We'll spend more on debt than defense. And here's the scary part, if it could get scarier. When the government is spending more on debt payments than the entire defense budget, guess who they squeeze for tax money? And guess which loans banks stop making first? Yours. And yours. A 1% rate hike used to cost us $360 billion. Now, 10 times bigger powder keg. But what does this mean for you? Someone actually trying to get ahead? Well, let's zoom in. Meet Leonard. He's not new, mid-40s, closes deals, mastered off-market deal hunting with old-school hustle and new tech tools. He's hungry. He wants passive income so he can stop hustling deal to deal. He's a big fan of the channel. So he finds the perfect fixer-upper. He negotiates hard, locks in a killer price, but the bank only funds the purchase. Nothing for rehab or holding costs. He tried to negotiate, but nope, that's not how these loans work, they said. Seller has other buyers. Time's up. Leonard needs funds for everything. Now, or he loses the deal. And here's where the system bites. New banking rules just made it 19% more expensive for banks to lend on real estate. What does that mean? Banks have to set aside 19% more cash for every real estate loan they make. So they're making fewer loans. And the ones they do make have stricter rules. Guess who eats that cost? You do. Leonard loses the deal. Watches someone with faster, flexible cash snag it. He's furious. He did everything right. But the money system is built to keep you stuck. But here's Leonard's light bulb moment. He found a different way. 3 months later, he closed 4 deals using private credit while his bank was still reviewing applications. Leonard adapted. Most don't. And Leonard's story isn't rare. It's the new normal, actually. Banks tighten, lending standards shift, opportunities slip. And here's the connection. When the Fed warns about bond market cracks and the government is drowning in debt, banks get scared. Scared banks don't lend. No lending means your deals die. And if Diamond's warning is right, this only gets tougher. Look, I've seen this myself. In 2023, one of my own clients lost 3 deals in a row to cash buyers because his bank slowed down mid-funding. If you rely on traditional money, you're rolling the dice. Real estate works if you play the real game. Most people are stuck, chasing approvals, stacking paperwork, praying money shows before the window closes. And here's the reality. Bond markets are like the ocean. Banks are fish. When the tide, Fed liquidity, leaves, stranded fish die first. That's why we saw regional banks collapse. What this means for your deals? When banks are struggling to survive, your loan application isn't their priority. Their survival is. It's not 2012, not even 2020. Banks are scared. Credit is drying up. And here's the math that kills deals. A 0.5% rate hike equals $180 billion in new interest costs for the government. And when the government pays more for money, everyone pays more for money. The Fed can't unload its $6.7 trillion in mortgage bonds without crashing the housing market. And that means they're trapped. They can't raise rates without destroying real estate, but they can't lower them without destroying the dollar. And even if you're doing creative deals, sub-2, seller financing, all the stuff we love here so much, it's the gap funding, the rehab cash, the marketing costs, and the speed that separates the pros from the stuck. Feel the game's rigged? Yeah, you're right, it kind of is. But here's what most people miss. The game changed, but it didn't end. You just need to know the new rules. Is the problem real estate? Or the way you've been told to fund it? What if the choke point isn't the market? It's the kind of money you're chasing. Stop begging banks. Follow the smart money, the ones who moved first. I mean, think about it. While you're waiting for bank approval, someone with private funding is closing your deal. If you had that type of funding, would you still be watching deals slip away? Or would you be scaling while others wait for approval? Insiders know this. Private credit jumped to $1.5 trillion. Morgan Stanley says it'll be $2.6 trillion by 2029. And here's what that means. While banks got scared and pulled back, private lenders stepped in with 1.5 trillion bucks. They're funding the deals banks won't touch. The smart money didn't wait for banks. They built their own system. The ones who plugged in, they thrive when markets shift. And in 60 seconds, I'll show you exactly how to tap into this. But first, you need to understand why banks can't compete anymore. They're regulated to death. Every loan they make, they have to set aside cash reserves. When rates go up, they lose money on their old loans. When the Fed pulls money out, they have less to lend. But private credit, no reserves required. No old loans dragging them down. No Fed dependence. They can move fast, lend on deals banks won't touch, and fund the whole project, not just the purchase price. That's why Leonard's Bank said purchase only, while private credit said, here's everything you need. You don't have to play the old lending game. This isn't a secret. It's the new institutional normal. Billion-dollar deals use private credit, and it's open to you if you're moving fast. So now you know the rich use debt to build unlimited wealth, and you know why banks can't help you do it anymore, or not like they used to. Well, great. I'm screwed. How am I supposed to borrow like the rich if banks won't lend? I get it, but here's what most people don't realize. Banks are just a small part of a borrowing like the rich strategy. The wealthy stopped relying on banks years ago and moved to private funding sources most people have never even heard of. Now, I've put together the epic funding playbook that breaks down the 3 types of debt every real estate investor uses. And you can grab that in the description if you want to dive deeper into those strategies. But right now, I want to show you a completely different approach that doesn't even require private lenders. This is one the wealthy use all the time, but most people don't even know it exists. Hey, this house right here is now mine, and I used OPM, that's other people's money, to buy it, and I've got no payments on it either. But how? I changed one small thing, and the no payments method was born. Listen up, if you're serious about investing in real estate, you need to know about what's possible when it comes to seller financing. Working with banks, it takes too long, the rules are strict, you need a job, you need a credit score, you need money, and it's just so much harder than it has to be. You've got faster and easier options. For example, I'll show you how I structured this seller finance deal right here with 0 payments. Sick, right? Yeah, you ready? Let's go. What's up? It's Matt at Epic, and if you're new here, glad you found me. If not, great to see you again. Let's waste no time. This creative financing technique, seller financing, requires no credit check, no appraisal, and no expensive lending fees either. And I'll guide you through 1, how I introduce seller financing to a seller so that they're more receptive to it. And 2, how I structure the paperwork. And 3, I'll walk you through step by step what I just did to get this deal seller financed with 0 payments. And stay tuned till the end, and I'll give you a copy of the terms that I use most of the time, the clauses for my contracts, and some nice deal structure templates to help you get started too. All right, seller financing, it's my secret sauce, but it wasn't always. Initially, I didn't know what it was, and then when I learned what it was, I still didn't know how to do it. And then I had all these other fears in my head of all the worst case scenarios, the legalities and the legal jargon, and then mostly the fear of a seller laughing me out of the room for just suggesting it, because I just couldn't wrap my brain around why a seller would give me financing. But fast forward, I've got easy fixes for all of these now, and I'll address them all for you as soon as you click the like button. Before I walk you through the how, let's quickly answer the what. Seller financing, it's a type of real estate agreement that allows the buyer to pay the seller in installments over time, rather than using a traditional mortgage from a bank. Seller financing is like a bank loan, except that it just cuts the bank out of the loan and allows the seller to own, oversee, and benefit from the debt. Now, you may be thinking, Matt, didn't you just say you bought this property without having to make payments? I mean, how does that work? Well, good question. And I'm going to show you how it works. And know that you can do it too, as long as you have these 3 things working for you. The first thing that you need is an understanding of the relationship between price and terms. The second thing is you need a motivated seller. And 3, you need a good presentation. So I'm going to cover all 3 of those. First, the price and terms of a real estate sale, it works like this. This is the deal dynamics axis. The vertical line represents the price that I pay, and the horizontal line represents how or how long I take to pay the price. If the seller wants their money now, like ASAP, controlling the time of when they get their money, I take control of how much money they're going to get. So fast cash for the seller means low price for me, right here on the axis. Seller says, no way, Jose, I need a higher price. Then I need a longer time to pay the price. That's the exchange, the relationship between price and terms. It's a give and take thing. And as long as you're taking control of one or the other, the price or the terms, you've got yourself a deal. For example, on this property, the seller wanted full price, way up here. So no problem. I'm going to take control of how and how long I'm going to take to pay the seller's price. And that's the beauty of creative financing, because how I pay the seller's price has an unlimited number of possibilities, as you can see here. These are just some of my options, by the way. And when you start combining them, the sky is the limit. It's by combining them that you accidentally create something called the no payment method. Now, I've done something like this before. Most of the time I do this in one of two ways. By deferring, that's a postponement of an action or an event, like deferring interest or profit, or in this case, payments. Typically, interest doesn't accrue during a deferral. The second way is via a moratorium, which is an authorized period of delay in the performance of a legal obligation or the payment of the debt. Interest generally does accrue during a moratorium period. But there's now, for me, this third way that I want to tell you about that's so much better, especially if you like cash flow. So here's the deal. I pulled a highly targeted list from Deal Engineer in St. Louis of vacant houses with a probate lien and delinquent tax activity, and then I cut the size of the list in half using their AI predictive analytics, their artificial intelligence, to just 50 houses of a small list. And then I put them in my seller sniper campaign. Now, there's this lady, Cora, a widowed retiree in her mid-60s. She was struggling to sell her rental property. We've got a symptom of a motivated seller. We need that for this to work, right? Cora had initially hoped to sell her property for top dollar like all sellers do, but after a few months, realized that the house's condition, it was driving buyers away. They were passing on it. She didn't want to deal with or pay for a full-scale renovation, though. It was becoming now a financial burden for her, but a mental one more so, because she had just sold her home and was leasing it back temporarily from the new owner while she tried to sell this rental property. Cora had the plan to sell her two St. Louis properties in order to downsize to a smaller, more manageable place closer to her daughter in Texas. And this is when she called me. But because of the condition of the property, I couldn't give her the price that she wanted. She was at $174,000 and I was more like $85,000. The property, it needed serious work to get it to its full market value of $200,000. And once it was clear that she wasn't budging from her price, I had said, like I always do when this happens, reluctantly, of course. And this is the good presentation needed. It's so simple a fifth grader could understand it. It's like this. I said, Cora, you know the market may allow me to get closer to your price if you're willing to take some money now and the rest later. How much do you need right now? You see, I just asked her for seller financing without saying seller financing or using any other industry or legal jargon. You know, if I confuse them, I lose them. So I keep it super simple. So Cora and we went back and forth a bit, and she said, I need at least $75,000. So I was like, eesh, because that's like more than 40% down. I was like, well, okay, that's much more than I normally put down, but if I could get that for you, could I break up the balance into 300 equal monthly payments? See, that would have been like $330 a month, and the market rent for the house is $1,400. So that's a pretty strong cash flow. But because she wants so much money down, it's just a hair over an 8% cash-on-cash return, which it doesn't suck, but it's not great. She did some quick figuring, and she was like, I'll be dead before you pay that off. And that's definitely not the first time that I've ever heard that. And so I asked how many payments would be acceptable. And she came back with 100 payments, which takes me up to $990 per month payable to her. And that pushes the cash flow and ROI into negative territory. So that's a no-go for me. I said, Cora, I like the house and I could put some money down, but probably not more than 10%. So at $174,000, that would be $17,400. And she wasn't cool with that. She needed that $75,000 to bridge the gap between what she sold her house for and what she's buying the new one in Texas for. So here's what I proposed. Cora, I can't give you more than 10% down because I need my cash for other deals. But let's say that I agreed to the monthly payments of $990 and I went and borrowed the money for that to pay you the first 5 years in advance. That would give you $59,400 in upfront payments plus the $17,400 down payment for a total of $76,800 at close. And then after 5 years, I'll send you $990 every month until paid in full. And that way we can both get what we want. But in order for me to get that loan, my lender would need to be in first position. Would you be open to that? Now, she didn't really know what that meant, so I had to explain it to her. And I explained it like this. When a bank loans money to someone to buy a house, and we'll use this one as an example at $174,000, that loan, let's say it's 80%, would be $139,200. That gets recorded against the property as a security to the bank. Now, if the borrower fails to make their payments, the bank can foreclose and sell the property, usually at auction, to get their money back. That's how banks are protected. And you are protected in the exact same way. But when there are two loans on a property, whichever loan is recorded first against the property is considered to be in first position, which has a higher level of protection in the event of a default. It's like this. If there were a second loan used for the difference, $34,800, that loan would be in second position because it was recorded at a later date and time. That's how the positioning is determined. And the positioning is really important because it determines the loan's priority in terms of repayment and their rights against the property. And here's how that works. If the property were to go up for sale at a foreclosure auction because the borrower stopped paying, and it was to only sell for, say, $150,000, the first position loan gets paid first, and whatever is left over, $10,800, will go to the loan in the second position, which in this scenario isn't enough to cover the second loan. So the second position lender loses $24,000 in this example because they had a lower priority. Being in second position, it's riskier. And she understood that. Being in second position, it can be a real disadvantage under normal circumstances, but not necessarily when you're in second position to yourself. So I drew out what it would look like in our deal. I'm buying the property from Cora for $174,000. My lender will give me $76,800 to give to Cora, and he'll be recorded in first position. Cora will then carry back a second loan from me of $97,200. That'll be recorded in second position, where I'll also give that money to Cora. You see, Cora is the beneficiary of all the money in first position and second position. She's in second position to herself. So if the property drops below the market value or the loan amount, it's not a total loss, likely not a loss at all. Cora can take the property back, keep all the money that she had received since the time of the sale, including the upgrades that I had made to the house, and then she'd have the opportunity to sell it all over again, making a boatload of money. Now, yes, it would be an inconvenience for her, maybe. That would be like the worst case scenario, but it would be a huge windfall for her at best. Being in second position is definitely a risky place to be when it comes to a loan other than yours. But when you're in second position to yourself, not so much. And the relief, it was palpable in her voice when she agreed to move forward. For her, it wasn't just about the money, not too much about the money at all at this point. It was about having the freedom to move on to the next chapter of her life. So with creative financing, this new no payments method, I managed to turn a roadblock into a win-win for both parties. So this is how it was written on the contract. Purchase price, $174,000. Terms of purchase, buyer to pay seller $17,400 as a down payment. Seller agrees to carry back the balance of financing for the buyer at $990 per month until paid in full. Buyer agrees to pay the first 60 payments in advance, $59,400 due at closing. Just like that, simple, nothing fancy. So here we've got no banks involved, no credit check, no appraisal, no expensive lending fees, and no payments to the seller for 5 years. And now I do have a $396 payment to the lender that I borrowed the down payment from, but it's not $990, which allows me to comfortably cash flow $444 per month for the next 5 years. Annually, that's $5,328 of passive income. And now what's my cash on cash return? Because it ain't 8% anymore. Let me know in the comments below. Now, even seller financing, it can take some time to find those types of deals and negotiate them. But what if you need to move on a deal in days, not weeks? What if you could have funding ready before you even find the deal? Well, that's what I'm about to show you how to do in this video right here.